Welcome back. It's time again, time to revisit Tesla. And I would talk about a company that manages to get in the news, sometimes for good reasons, but often for all the wrong reasons. And right now, Tesla seems to be in the crosshairs. The distractions are mounting. Starting with Elon Musk and his escapades with the SEC, talk about electric lawn blowers, the debt spiral that might be created by debt. In every conceivable way, this is a company that manages to step on its own lines, get in the way of its own story. But I want to go back and look at the company because I still remain optimistic that there is a way that this company can make it to becoming an incredibly successful automobile company. So let me go back in time to June of 2018, which is when I last valued Tesla. At that time, the stock was trading at 360, and the story I told about Tesla, and I described it then as an optimistic story, was a company that would be managed to increase its revenues almost eightfold to $100 billion. And while it was increasing its revenues, and find a way to improve its pre-tax operating margins to 10%, well above typical automobile company margins. But in my view, the company has a brand name, has a capacity has some pricing power that will allow it to earn those margins. Finally, to make this story complete, I also assume that the amount of reinvestment that Tesla will need to make is less than a typical automobile company. I'm not buying into Elon Musk's robots on the assembly line completely yet, but he's managed to find a way to extract more cars out of that Fremont plant than I ever thought possible. So I'm going to let them to grow with less reinvestment than a typical automobile company. The bottom line is, with those assumptions, here's what happens. As the company goes from small to large in revenues, as its margins improve, and as its reinvestments start to tailor down as growth comes down, the company's value starts to become much larger. In fact, the value that I get for the stock reflects also the assumption that there is a mild risk, partly self-imposed because Tesla went out and borrowed all that money for no reason at all. They could have raised the capital with equity that puts them at risk, and in 2018, that risk I assessed at about 5%. The end game is I valued the stock at about $170 to $180, about half what the stock was trading at then. So at that point, my conclusion is Tesla is overvalued. I'm not going to take the risk of going against the stock, of selling short, because this is a stock where mood, momentum, and story can carry the price further away from the value. I essentially walked away from the company. A couple of months later, as is his wont, Elon Musk put himself back in the news again with his now infamous tweet about funding secured for a $420 buyout. And when it came out, my reaction was, really? Tesla is the target of a private buyout? It doesn't seem to me the right target. It's a growth company where all of its value lies in the future. It's got a substantial amount of debt, and it's got Elon Musk and its management team. What buyout team would want to take this company private? And it turned out that the funding was not exactly secure, that the $420 was more fiction than fact. And in fact, that tweet has created a host of problems for Tesla in the months following, which I'll come back and review in a few minutes. So the funding secured clearly wasn't there. The $420 was essentially made up, and you can see essentially that it's these distractions that effectively have pushed the company to where it is today. So let's talk about what's happened since June of 2018. For a company like Tesla, lots of things seem to happen. First, let's start with the good news. The good news is those Tesla 3s that started rolling off the assembly lines started to push up revenues, and the revenues have almost doubled over the course of the last year. Their margins have actually also moved in the right direction. They're still not quite making money on a consistent basis, but they've had money-making quarters, money-losing quarters, and I think they're further along the pathway to profitability, at least in terms of operating profitability, than they used to be. Now, what's the bad news? Well, most of the bad news in Tesla is self-inflicted. And first, there is that debt. And when Tesla borrowed $5 billion in 2017, I remember writing about it, saying, I could not think of a single good reason why Tesla would need to borrow money. It needs capital, true, but it can raise equity. You're saying, what about tax benefits? What tax benefits? Tesla has $7 billion plus in net operating losses carried forward. It's not going to pay taxes in the foreseeable future. There was no good reason for borrowing money, and that debt is not only still there, it's been added to. In fact, by June of 2019, that debt had mounted to more than 14 billion. And in fact, it was the talk about the debt. It was the Tesla bond market that was often on any given day causing stress and grief for the stock market because people were concerned about whether the company would survive. The second and other frustrating aspect about Tesla is, in spite of its great growth potential, all those people lined up ready to put down money for Tesla 3 cars, this is a company that does not seem to want to take advantage of that demand. In what sense? Well, if you're a company whose value lies in future growth and you have to deliver 10 times more cars than you are producing today, I would assume that you'd be investing front and center, putting up assembly lines, getting the capacity to deliver those cars. And one of the most frustrating aspects, if you're a Tesla bull, is how Tesla has played hot and cold on this topic. It goes from, Elon Musk saying they're cash flow positive. How can a company with this much growth potential even be cash flow positive? That story doesn't even make sense, because to create that growth, you have to reinvest money. This is a company that seems to delay and defer reinvestment, then go through stress points. Remember those 5,000 cars a week? How that drama stretched out? This is a company that consistently seems to not reinvest early enough and then have to worry about the capacity to deliver the cars. And that continued through the last year. And then, of course, this being Tesla, there are these news stories and your reaction is, what? What was that all about? I call these the Gobsmackers. First, of course, that tweet that Elon sent about funding secured has continued over the course of the last few months because it created an SEC action, which then led to a court case, which has led to at least a ban, at least some agreement where Musk is supposed to restrain himself on tweeting. Well, good luck with that. And my guess is this will continue in the next few months, perhaps even over the next few years. The second is a few weeks ago, Elon Musk threw, especially I guess it was driven partly by Lyft and Uber going public, and perhaps some envy that an Uber would have a higher market cap than Tesla. Elon tweeted out that about a plan to put autonomous cars and the autonomous taxis, with existing Tesla owners being allowed to supply or lend their cars to this fleet, where Tesla would essentially run the fleet and collect the cash flows. Given Tesla's history with supply chains and getting things running on time, I'm not sure I would want a Tesla ride-sharing business, but not to the extent that Tesla is further ahead of everybody else in autonomous driving. At least that's what the claim is. Maybe there is some basis, but already you can see this is a distraction for a company that already has a dozen things on its plate. And on top of that, there's a weekly distractions from Tesla. There was that electric leaf blower. I'm sure it was a joke, but if you're the CEO of a company and you joke about electric, how do we know whether Musk is joking about leaf blowers or whether this is going to be a Tesla new line? He also talked about insurance products. God help us, right? Tesla is not exactly the kind of entity you'd want offering insurance. But again, this is exactly the kind of distraction you saw week after week over the last year. So I decided it was time to update my Tesla story. And I'm going to surprise you. My base story hasn't changed. I still think that Tesla will end up becoming a $100 billion revenue company with margins of about 10% because the potential is there. There is more risk now than there was a year ago because that debt now, which was creating a 5% chance of failure, is now, I think, up the ante, and it's now a real and present danger. And I'm going to increase the chance that something bad can happen. You're one big shock away from a debt crisis, and that's going to be bad for equity investors. So I'm going to put the chance of failure at 20%. So I was thinking about a name for the Tesla story now, and I was reminded of teenagers around the world. You know how when you look at teenagers, you're puzzled by them. I mean, you were teenagers once, or you have teenagers, you have kids who are teenagers. You say, how could you put all that potential at risk by doing something that stupid? Because every day around the world, I think teenagers wake up and they ask the question, I have lots of potential. What can I do that is really stupid today to put all that potential at risk? That's effectively what I see Tesla doing pretty much every day. Maybe it's unfair to bunch this all in Tesla. Maybe it's Elon Musk who's the teenager. But this is a company that is going to frustrate you like any teenager will. So I'm going to call it my corporate teenager, and perhaps it's time for a curfew. So here's my Tesla valuation, updated June of 2019. I'm starting with a much more solid base than I did. Revenues are now much bigger than they were a year ago. So I'm starting with a more solid base, both in terms of revenues and where my operating margins are. Because when I capitalize R&D, Tesla is in fact turning an operating profit. So I think it's going to be easier to get to the 100 billion and the 10%. I'm not going to increase those targets. I think Tesla has enough on its plate that getting those targets will be tough enough. It will still have negative cash flows over the next few years. It will need to raise capital, about maybe $7 to $8 billion in capital, to get to this endpoint. But with a 20% chance of failure. What does failure mean? That you'll have to sell the Tesla business for half of what it's worth to somebody who'll buy it off your hands. And the value that I get for the company now is about 190. It's a little higher than it was a year ago, and you're wondering why that is. I decided to do a comparison of my June 2018 versus June 2019 numbers. You can start with the good news: higher revenues, better operating margins, so that allows me to start from a more solid place. My end game is pretty much the same, about 100 billion in revenues in 2028 and about a 10% operating margin by year 5. And what's in terms of risk, I think there are two factors, one of which works against Tesla, which is the higher chance of failure, 20% chance of failure. The other is a macro factor, which has worked in favor of Tesla, which is risk-free rates are lower, which pushes down the cost of capital for all companies, not just Tesla. So the end game here is my value has not changed very much, but the price certainly has. It's gone from 360 down to 186 when I did this valuation. The stock has gone from being massively overvalued to mildly undervalued. I'll come back and talk about what I'm going to do with that. But this is a company where there's always been divergence among different investors. So I'm sure that some people will look at this valuation and think of it as hopelessly optimistic. Others will view it as hopelessly pessimistic. And in fact, you can divide the bulls and the bears on Tesla on the 4 big variables that drive its value. One is revenue growth, where the bulls believe that $100 billion is way too small, that you should be going for 250 or 300 or $400 billion, where Tesla will be selling not just a million, say 1.6 million cars like I'm estimating, but maybe 3 or 4 or 5 million cars. The bear case is this is a company that's never going to get to a million cars. The revenues, if you're lucky, might end up at a 50 to 60 billion. My base case kind of splits the difference, puts it about 100 billion. The operating margin, there are bullish investors out there who believe that Tesla, if it pulls off its become an operating company, will have margins like luxury automakers and maybe even technology companies, 14-15% margins. The bears, of course, believe that that's complete nonsense, that Tesla will be lucky to get to the margins of the automobile sector, which is about 6%. Here again, I've split the difference. I've gone with about 10%. For reinvestment, the bulls believe that Tesla can invest like a tech company. Essentially, it can get away with a much smaller investment than a typical automobile company. They buy fully into the robots technology argument that Elon Musk has made. So the way this manifests itself in the valuation is how much revenue you get per dollar of capital, and they can assume $2.5, maybe even $3 in revenues for every dollar in capital. The bears, of course, believe that it's an automobile company with assembly lines. It'll invest like a typical automobile company, which is closer to where revenues and invested capital kind of go together. So it's a ratio of 1. Again, here I've split the difference in my base case. And the risk of failure, the bulls assume that there's no risk of failure. The company will not, or very low risk of failure, maybe 10%, maybe even 5%. The bears believe that the debt is going to bring this company down, maybe 30%. I've split the difference again. And you can see that the values you can get can be wildly different depending on whether you're bullish or bearish. I got a $190 value, but with a bull case with $250 billion in revenues and or $300 billion in revenues, maybe at 14 or 15 or 12% margin and a low reinvestment, you can end up at $600 per share. What does this mean? If somebody wants to buy Tesla and argues that they have a bull case for it, I'm not going to argue against them. Maybe they have a story that explains it. And if somebody else says they want to sell short because a company is worth only $50 per share, who am I to push back and say you're wrong? So my base case is my base case. Your base case has to be your own. One of the things I did do in my base case was I asked, was I allowed, what I call facing uncertainty in the face. You've seen me, or looking uncertainty in the face. You've seen me do this on other valuations, where I've essentially taken my base case assumptions and allowed them to become distributions. In this case, I've taken 4 big assumptions. One is my growth in revenues, which drive my end revenues. The second is my operating margin, which I've assumed to be 10%, but could be higher or lower. The third is the sales to capital ratio, which tells you how much you reinvest. And finally, the risk of failure. And since revenue, the risk of failure, growth and margins are all going to be linked up. In other words, if you have high growth, high margins, you're probably going to have a low chance of failure. If you have low growth, low margin, you're going to have a high chance of failure. I've linked them together with correlations. And I ran the valuations. And if I run these valuations, June 1st of 2019, across I ran 100,000 simulations, my median value is about $180. At the 60th percentile, I get about $212. The 40th percentile at about $150. You can see the distribution. One aspect of the distribution is there is a right tail here. The optionality, the autonomous cars does provide an optionality. That optionality could be worth some money. In other words, I'd be much more likely to pull the trigger on Tesla if it's undervalued. Couple of interesting side notes here. One is there is talk that at a certain value, Tesla could become the target of an acquisition. 2 things have always been a barrier to another company acquiring Tesla. The first is, as the market cap for Tesla has risen, it's become too expensive for somebody to acquire. Who wants to acquire a $60 billion electric car company? But at $15 or $20 billion, that problem goes away. The second problem is more long-standing, which is if you buy Tesla, as part of the package, you get Elon Musk with it. What company in its right mind wants to buy Elon Musk and put him in the midst of the company? You could take $1 trillion company and melt it down with Elon Musk in the middle. So I think that second problem is going to be a much bigger problem. But who knows? If the value of Tesla drops to $10 or $15 billion in terms of market cap, Elon Musk might decide he'll leave, or he might be pushed out. There might be a greater chance of that happening. If you do put an acquisition floor, your base case value increases, because what it does is it removes some of the worst outcomes in the simulation. In fact, putting in a floor where the Tesla gets acquired at $10 billion increases my value to about $200, my base case value to about $200 per share. So that's something to factor in. One final side note before I pull everything together. I usually don't comment on other people's valuations of companies. It's no business of mine. I'm not some high priest who decides what's right or wrong. But in this case, I'm going to make an exception because ARK Investing, which is a portfolio management firm, has put out has been one of the biggest bulls on Tesla, and they put out their valuation of Tesla on an Excel spreadsheet on GitHub for comments. And I said, since they're inviting comments, I might as well give it to them. And I do this again not to kind of pick apart, but it's because I'm curious about what a real bull on the company thinks about the company. So I pulled up their spreadsheet, and the first thing I noticed, it's not a valuation, it's a pricing. Now you might think I'm nitpicking, but a valuation requires you project cash flows every year. You do a full-fledged projection of cash flows, you discount those cash flows, you come up with the value. It's an intrinsic valuation. This is not a valuation, it's a forward pricing. And let me explain what I mean by that. Notice there are only 3 columns in the ARK numbers for Tesla. The first is the base year, the second is what they call their bull and the bear years, both in 2023. And what they basically do is they project out revenues, EBIT, EBITDA, and EBIT before interest, depreciation, and R&D, and that becomes the base number. So in the bear case, for instance, they're projecting that Tesla will sell 1.7 million cars in 2023, have 85 billion in revenues, have operating margins of about 6.1%, and have an EBITDA before R&D of about 15.3 billion. What they do then is they apply a multiple to that EBITDA R&D based on what other automobile companies are trading at, 8 times that number. 8 times 15 gives you about 120 billion. They've paid off the debt, so that becomes the equity value, and the equity value translates into value per share, of about 597. To give them credit, they do increase the number of shares between now and 2023 because they've got raised capital. All in all, it's a pricing, it's a forward pricing. I don't have a problem with pricing, but let's take a closer look at the pricing. The first is to recognize, let's not call this a valuation, it's pricing. The second is this bear is pretty bullish. I mean, to have a company that sells about 225,000 cars, increase the number of cars it sells to 1.7 million in 5 years, while also pushing its margins up to the average for the sector. And to call that bearish is in my view, a very strange definition of bear. The bear case for ARK looks more like a bull case than a bear case. Maybe there should be a bull case with autonomous cars and bull case without autonomous cars, but the bear is pretty frisky here. And the weakest link, and to be quite honest, I don't have each of the numbers by themselves are plausible. Could Tesla sell 1.7 million cars in 2023? I think so. The demand might be there. Second, could it improve its operating margins to 6.1%? I think so. Could it do both at the same time? Perhaps. So far we're on the plausible ranks. The weakest link for me in the ARK pricing is in the reinvestment in the cash flow. It's a little difficult to actually reverse engineer what they're reinvesting because they give you only 2 years of numbers. But the key number for me is the net property, plant and equipment, which is a big line item. I guess we're doing balance sheets, but that is the cumulative reinvestment in land, building, equipment, assembly lines. And if you look at that number for Tesla, it goes from 11.3 billion to 50. I'm going to focus just on the bear case. The bull case, I'll come back and talk about why I don't even think you can make much of an argument around it. But in the bear case, where they're increasing their car sales by about 1.5 million and their revenues by about 64 billion, the net property, plant and equipment increases by about 3.7 billion. Now their working capital, they have a number called working capital required in 2023. I'm not sure whether that's the increase, whether it's a total working capital. I'm going to give them the entire 1.2 billion as an increase in working capital. If you add those two numbers up, their increase in invested capital is about 4.97 billion. And I don't know whether this is a mistake or an oversight or whether it was intentional, but the debt seems to disappear, which means you repay the 14.17 billion in debt. Let me pause right there. Your invested capital is increased by 4.9 billion. That's pretty magical to be able to increase your revenues by 64 billion. Your invested capital is increasing by only 4.9 billion. Now, and the long-term debt disappears. So even in the ARK case, if you go buy into the bear case, it looks like they will have to raise about, if you repay the debt and you have about 20 billion, maybe 25 to 30 billion if you bring in the negative cash flows up front. So that's a lot of cash flow capital to raise. Now, to give the company credit, they do assume, to give ARK credit, they do assume that there will be an equity capital raise of 10.6 billion, but that strikes me as too little, too late. I mean, it's not going to cover the debt repayment and the new reinvestment needed. The balance sheet will not balance, at least given the numbers that are out there. It then adds to this problem by assuming that the 10.6 billion will be raised at a stock price of $360 per share. Well, that might have worked in June of 2018, but in June of 2019, the stock is down to 180. If the argument is the company will wait till the stock doubles before raising capital, it needs to raise the capital now to get the assembly lines going to be able to sell 1.7 billion. And finally, if stock prices do climb, as ARK seems to assume, there are about 32 million options waiting to be exercised. About 11 million are in convertible debt that will get converted. But there's also this incredibly large CEO package that was given to Elon Musk of almost 22 million options. Each of they're not triggered yet, but they will be triggered if market cap starts to rise the way ARK does. In effect, the share count you're going to have is going to be much, much higher. Even if you buy into the ARK base case, then if you look at their actual numbers, they're projecting the share count will increase from 178 million to 208 million. That's in the bear case. I don't even think that's going to be even close. I think you'd be lucky to get to, if you could keep the share count below 300 million or even 350 million. So even if you take the bear case as given, assume Tesla can sell 1.7 million cars push their margins up to the average for the sector, with ARK's own story, the value you're going to get is about $250 per share with a more realistic share count, not the 560 you see. You say, what about the bull case? The bull case is right now more fairy tale than valuation. Because in the bull case, here's what happens. By 2023, there are 7.2 million autonomous cars on the road. And Tesla has a 70% market share and generates 52 billion annual cash flows. If this is true, by 2023, Tesla will be more of a ride-sharing company than an automobile company. But I am skeptical. I'm skeptical, A, that we're that close to autonomous cars hitting the road, that B, that Tesla will have a 70% market share, and C, that this will be as cash-rich a business. Where are the Ubers and the Lyfts and the Waymos going to go? Are they just going to disappear? I mean, this is as lucrative a business as ARK makes it out to be. There's going to be competition aplenty. And I don't see this unfolding. So right now, I'm not ruling out the autonomous car option, but I think it's more option than cash flow. So it's something I would add as icing on the cake, but I wouldn't bake it into the cake. So here's my bottom line. I value Tesla since 2013. I've been wrong on Tesla, sometimes massively so before. And when I first valued Tesla, I was wrong on two counts. First is I saw them as a luxury automaker. I gave them revenues of only 60 billion in 10 years. I think I was wrong. I think I understated their projected revenues. I also overstated how much they would have to reinvest. I really did not forecast how much production they've been able to extract out of that Fremont plant. But I've tried to correct. Over time, I've allowed them to grow much more than I did initially and reinvest far less than the typical automobile company. But in spite of trying to correct, I've never been able to find the stock to be undervalued in all the years that I valued it, 2014, 15, 16, 17, 18, until this year. I'm not sure that this is a turning point, but for the first time in the 7 years that I value Tesla, I find it undervalued. In fact, I'm going to go further. I've always, people, when I've come up with, concluded that Tesla is overvalued in prior posts, I've always been accused of being negative on Tesla, not liking the company. I'll tell you, I quite honestly like Tesla more than any other automobile company. I like the way the company has shaken up the business. I don't like what Elon Musk does at the top of the company, but that doesn't mean I want the company to succeed. And I've said before that I've always wanted Tesla in my portfolio. And I think the time is here. And I put in a limit buy at 180. I know that sounds radical, but if I can buy Tesla at 180, I will earn my, on an expected basis, I will earn my 9% plus returns. And if I can live through that 20% risk, the returns will be even higher. And to add to that, if autonomous cars kick in, that's an option. That's the icing on the cake. So I'm going to jump in at 180. Of course, it's not quite at 180 yet. It might never get there, in which case I'll wait, because this is a stock, that I will return to over and over again. And one of these days, if it's not this year, I will. But this is as close as I have ever gotten to buying the stock. So thank you very much for listening, and I hope you enjoyed this talk.